Hi, this is Mike Larson for Money and Markets TV. Interest rates are the lifeblood of the capital markets and the real economy. Lower rates and easy money fuel asset bubbles and economic activity. Higher rates and tighter money pop those bubbles and restrain growth. It's as simple as that. So the latest move in the U.S. bond market bears extremely close watching. Just a few days ago, long-term Treasury yields exploded out of the range that they've been mired in since last summer. Now the move wasn't huge, up about half a percentage point from recent lows. But if this is the beginning of the end of the low interest rate era, it's going to have a massive impact on all kinds of assets. And that means you'll need to start adjusting your investing strategies now. The US has been borrowing and spending money like mad, just like they've been doing in Europe. But unlike Europe, we've managed to so far avoid the surge in borrowing costs and plunge in sovereign bonds that have destroyed the economies of Greece, Ireland, Portugal, Spain, and Italy. The reason the US has escaped that fate so far is massive monetary manipulation by the Federal Reserve and central banks overseas. You see, the Fed has been selling short-term treasuries and buying long-term treasuries as part of Operation Twist, a scheme designed to suppress those long-term rates. Plus, its counterparts overseas have been parking huge amounts of pounds, yen, and euros in treasuries simply because they have no other place to go. But now, signs of improvement in the domestic economy, rising inflation pressures, and long-term debt and deficit problems are all combining to torpedo the U.S. bond market. Earlier this week, 10-year note yields surged to a 5-month high of 2.29%. Long bond futures plunged 9 points in price from their recent highs, and that's one of the sharpest drops in some time. If you ask me, this is a clear sign that the Fed is finally losing control of interest rates. And in this type of economy, every small move higher in interest rates hurts more than it normally would, and that's because of the impact on the housing market. The housing market is still oversupplied, and lenders remain tight with their qualification standards. Indeed, higher rates could easily put the kibosh on the out-of-control move higher that we've seen in housing and related stocks over the past few months. So if you own them, sell them. Now, if you've been looking to refinance your mortgage, you shouldn't wait much longer. Lock in your loan rate now. And if you're buying or selling a home, make sure you factor higher borrowing costs into your decision. Meanwhile, if rates continue to go up and money gets tighter, the dollar should find support, and commodities such as gold and oil should lose some ground. At the same time, bond prices, bond ETFs, and bond mutual funds could take a steep header. So I'd recommend taking some profits and adding some hedges in these asset classes now, before this rate move really gathers steam. I'm Mike Larson for Money and Markets TV. Thanks for watching.